Did you just check your bank balance, waiting to see if that Social Security payment finally arrived? What you're about to learn will change how you view that deposit forever. We're stepping into a new era for these essential payments, and the vast majority of recipients are completely unaware of the switch that just happened. The agency overseeing these funds has rolled out a brand new calendar for sending out money, impacting tens of millions of people across the country. If your birthday lands in the first third of any given month, your funds are scheduled to arrive right now. But there's a hidden detail almost no one is discussing. This year's inflation adjustment is the most modest increase we've witnessed in 4 cycles, coming in at only 2.5%. For the typical retiree, that translates to roughly $48 extra each month. Don't get too excited about that boost just yet, because you have to see how rising Medicare costs are silently carving a piece out of that so-called raise. It's a classic scenario where they extend one hand while the other takes back. I'm going to guide you through the current situation with your finances, the exact timing you should anticipate, and 3 vital checks you must perform immediately to ensure you're receiving every single dollar owed to you. Let's dive into the specifics of what's occurring with your benefit right now. I've been hearing from folks nationwide who feel bewildered, annoyed, and genuinely concerned about whether their cash will appear on time. That worry is completely understandable. After laboring for decades and contributing to this program, you have a right to clear information on deposit dates and any changes from previous years. This entire system runs on a specific date-driven plan tied directly to your birth date. It's systematic, it's intentional, and while it might seem convoluted, it's not meant to mislead you, even if that's often the result. For individuals born from the 1st through the 10th, your payment is set for the 2nd Wednesday each month. That's today's date. If your birth falls between the 11th and 20th, you're aligned with the 3rd Wednesday, and for those with birthdays from the 21st to the month's end, your funds come on the 4th Wednesday. Now, a crucial exception exists here. If your benefits started before a certain point in 1997, or if you get both retirement and supplemental income support, your payment arrives on the 3rd day of each month, no matter your birth date. If that date lands on a weekend or public holiday, it moves to the nearest preceding business day. Why does this structure exist? It was created years ago to manage the operational flow for the federal payment system and financial institutions. In the era of physical checks, spacing out the deliveries prevented a total logjam on a single day. But we live in a digital age now, where most payments are electronic transfers moving from the U.S. Treasury directly into personal accounts nearly instantly. That's positive advancement. However, it also means that any hiccup or problem becomes apparent right away, rather than discovering a missing check in your mailbox days later. Now, we need to address this annual inflation adjustment, because this is the point where rightful concern turns into serious scrutiny. The official increase for this year is 2.5%. That seems like a helpful uplift until you calculate what it actually does for your monthly budget. The typical benefit amount last year was around $1,876 monthly. Applying the increase adds approximately $48 to that sum. But here's the harsh reality that official announcements don't highlight in their headlines. Medicare Part B charges are also climbing. The standard monthly premium now is $185. Last year, it was about $10.30 less. So immediately, a portion of that $48 gain is already absorbed. Does that increase still seem substantial? And we haven't even factored in prescription drug plan costs, which have also risen for many. This is why some look at their deposit and wonder why the net amount seems stagnant despite the announced adjustment. They provide a little more and then reclaim a share, betting that you won't scrutinize the interaction between these programs. You must scrutinize it. You need to examine your actual net deposit, not just the gross benefit figure on your statement. Let's discuss another shift this year that's flying under the radar. the income threshold for those collecting benefits before reaching full retirement age. If you're still working and claimed benefits early, meaning before your full retirement age, which is 67 for many viewers, there's a cap on your earnings before withholdings begin. For this year, that limit is $23,640 annually. Exceed that, and they will hold back $1 for every $2 you earn above it. For those hitting their full retirement age this year, the limit is higher for the months beforehand, and the withholding is $1 for every 3 over the limit. The painful part? People often forget or never learn about these rules, then face shock when they discover thousands withheld because their part-time income was too high. Are these penalties? Not exactly. They will eventually recalibrate your benefit upwards once you reach full retirement age to account for the withheld months. But in the short term, you have less cash on hand when you likely need it. Let's be real. Most people working in their 60s are doing so out of necessity, not passion. They need the income. Maybe savings fell short, or they claimed benefits too soon, or medical expenses are mounting. Now they're caught in a bind where earning more actually reduces their immediate benefits. It's a difficult spot many enter without grasping the full implications. Let's get actionable. I need you to verify something today. Go online. I understand some distrust technology, but this is the reality of modern finance. Visit the official Social Security website and set up a personal account if you haven't. Here, you can review your payment history, benefit details, and your complete earnings record. You must check that record. Errors occur more frequently than you'd assume. This is a huge bureaucracy managing countless records. Sometimes employers report incorrectly or data gets misfiled. If your record has mistakes, you could be receiving less than your true entitlement. I've encountered situations where people found missing years of income on their record. After corrections, their monthly benefit jumped significantly. That's your rightful money, earned and taxed. You deserve proper credit for it. Here's another crucial verification. If you are or were married for at least a decade, you might qualify for spousal benefits that are higher than your own. Many are unaware, and the agency won't proactively inform you as it increases their outlays. If your spouse earned considerably more during their career, you could be eligible for up to half of their full retirement amount instead of your own smaller benefit. The same applies if you're divorced from a higher earner. You can claim on their record without impacting their payments at all. They don't even need to know. But you must know and you must apply. They won't automatically grant you the higher amount. The principle holds for survivor benefits. If a spouse has passed away and was receiving benefits, you could be entitled to up to 100% of their amount. Again, you must claim it. You have to understand your rights and speak up for yourself, because no one else will. The administration is not your personal finance coach. They are an entity processing endless claims by the book, not tasked with ensuring you maximize your take. That responsibility is yours. Now, let's tackle the big anxiety, the long-term health of the Social Security program itself. You've likely heard the trust funds could be exhausted by the mid-2030s, potentially leading to across-the-board cuts of about 23%. That's frightening, especially if this income is your primary support. Let's add some context. Social Security isn't disappearing. Even if the reserves drain, ongoing tax revenue could cover roughly 77% of scheduled benefits. That's not ideal and not a scenario we should accept, but it's also not a total collapse. Ultimately, lawmakers will need to act, raising the taxable wage limit, adjusting the age qualification, or modifying formulas. It's frustrating they've delayed this for so long, but that's the political landscape. Focus on what you can control, your personal financial picture. Relying solely on this check leaves you exposed, regardless of the program's future. The average benefit replaces only about 40% of pre-retirement income for a typical career. If your career was uneven, it's less. 8.